Now, trading in the Forex includes some costs of doing so. Most of the time, those costs are the spread. The bid-ask spread is something that many of you, if you've had some experience in the stock market or with options or something like that, you may already be familiar with the difference between the bid price and the ask price. But there are a couple of ways that we can keep these straight. So the bid price is the sell price. So if you were selling to open a position, the bid price is what you're selling at. The ask price is the buy price. So if you're opening a position long or you're bullish, then you're paying the ask price, and there'll be a difference between those. So let's use an example here of the euro, and I'm going to keep this simple by only rounding this off to 4 decimal places, so a full pip on the end. So let's say that the bid price is $1.1952, and the ask price is $1.1954. Well, what that means, if we subtract these two, we find that the spread is basically 2 pips. Now think about it like this. Basically what that means is that if you were to buy and then instantaneously sell immediately, you would buy at the ask price and then you would automatically sell instantaneously, just as an experiment, at the bid price. Well, if you did that, you'd wind up losing 2 pips. And the same is true in reverse. If you were to short a position right away and then instantaneously buy it back, you'd be shorting it at the bid price and then having to buy it back at a slightly higher price, 2 pips higher. So these are the costs associated with trading in the Forex usually. Now, what are the factors that will affect the bid-ask spread? They are, number one, they're usually variable. Now, sometimes you can find spreads that are fixed, but it usually comes with conditions. So I rarely see the opportunity to really trade in fixed spreads that are fixed all the time. So it will depend on, well, what's the currency and what are market conditions, for example. So if the currency is really actively traded, then the spread, the difference between the bid and the ask, tends to be more narrow. So it's cheaper to trade more actively traded currencies. So liquidity is going to make a big difference. And market conditions, of course, will make a huge difference. As an example, what if there's been a big announcement from the Federal Reserve or the Swiss National Bank or something like that? Well, all of a sudden, that bid-ask spread can get really wide, and it can be very expensive to be trading very frequently in and out of a position. It will also vary depending on your dealer. So dealers will treat their customers in different ways, and they specialize in different kinds of trading sometimes. So there will be some variability in what those trading costs are for you than it is for other Forex participants. Now, why is that? Well, let's learn a little bit about dealers themselves. Now, number one, the currency market is a market that's traded over the counter. Now, what that means is that your dealer is your counterparty. So when you are buying, they're essentially the seller. Now, depending on the dealer, it may be that they have another party behind them who is acting as the seller. But either way, you're not sending it to an exchange to be cleared. It's being cleared by your dealer or by a partner of your dealer. So they're either sending it to a larger entity behind them, like a bank, to take the other side of your trade, or they're taking the other side of your trade. So they act as the counterparty, and that means that there will be some variability from one dealer to the next. Now, usually there's not very much, but there can be a little bit. Now, what this is called is an over-the-counter market, or OTC. There are a lot of institutional level over-the-counter markets. In fact, a lot of the largest trading instruments, swaps, and any customized derivatives and so forth that banks will trade with each other, those are over the counter. And most of the time, trading in the Forex is over the counter. That's what that means, is that we're trading over the dealer's counter. So we're not sending it to an exchange where there's as much transparency in some ways as there may be in the Forex market. So let's talk a little bit about orders and what that means. So we know what the spread is, but what about actually executing an order to be able to get into a position or to get out of a position? How do we actually do that? What is that called? What are the terms for that? Because there's a lot of ways that we can customize the way that we're opening a position or closing a position to really suit the strategy that we're in. Now, generally speaking, orders, we're going to fall into one of two categories. There's a market order. Now, a market order is basically whatever you're saying, you're telling your dealer, I want as close as you can get to whatever the current market price is. Now, the Forex market is really actively traded. It tends to be super liquid most of the time. So whatever price you see in the market at the time that you put in a market order, usually that's the price you get. Now, that's not always going to be true, but usually it's pretty darn close. Is that you'll get the current market price because it is so liquid and actively traded. However, pending orders is another approach. Now, the most common pending order is some form of a limit order. Now, this is an order where you are telling your broker or your dealer what is the price that you're willing to pay to get into a position, or what is the price that you're willing to accept to get out of a position, and they won't fill you unless they can actually give you that price. So let's look at a couple of examples of this. Now, we're going to assume here that a trader is looking at the market and they think they've got an opportunity on this little breakout here. Now, this is the pound, and they think they've got an opportunity to go long at 136 even. So they think there's a breakout right there, and they're going to use a market order. Now, what that means is that they would expect that they're probably going to be filled approximately at that level. So maybe they're going to be off by a little bit, but they might choose to use a market order if they were more concerned about their fill. In other words, they just want to get into the position or get out of the position. They're not as worried about the specific price that they're getting. Now, the alternative here would be to use a limit order. Now, in this case, let's assume the same scenario. This is still the pound to the dollar, and we're going to still suggest that this trader wants to be able to get in at $1.36. We're just going to use that even in this case. Now, they put in a limit order at $1.36. Now, what that means is that they will not be filled unless they can actually get that price. Now, here's a couple of things to remember. The way that limit orders work in the Forex, usually you can, if you're buying, you can only put the limit order underneath the current market price. So if you want to be able to get a buy order in at a specific price that you designate with a limit order, then you need to put it at a price just slightly below what the market price is. Now, the opposite is true. So if you are selling, you can use a limit order there as well. So if you're opening a position as a short position where you're a little bearish on the market, well, we can do the same thing. If you're more concerned about getting a fill, you can use a market order. If you're a lot more concerned about getting the exact price that you want, then you would use a limit order. Now, there's more to learn here with order types, and we're going to dig into them later in a future section on risk control. But for now, these are the basics, and if you can master an understanding here of market orders versus limit orders, you're most of the way there in understanding how order execution actually works in the Forex.